Hello and welcome into CrushTheStreet.com. I am Kenneth Amaduri and I'm joined today with Nicholas Green of FMT Advisory, where he's a fiduciary advisor. And he's been a fiduciary advisor since 2003, and he's an expert when it comes to value investing. He has a wealth of knowledge to share with us, and I'm excited to talk with him today. Nicholas, thanks for joining me.
Hey, Kenny. Thanks for having me. It's great to be on your show. Opt out of conventional wisdom. I think that's exactly what folks should be doing, and I've listened to a lot of your interviews, and they've been great. You've had some really good thought leaders, so hopefully I'll do your show some justice. As Hendrix once said to Clapton, as they share the same stage and we're on the same bill, I'm going to have to pull out some stops. So I just hope I can pull out some stops for your readers today.
Sounds good, Nick. Sounds good. Well, today I want to talk to you today about the Dow-Gold Ratio. And this is an important thing, especially now with the Dow Jones being high and gold being low, and people have heard about the Dow-Gold Ratio, but I want to get your thoughts on why this is important and where we're at today.
Well, this is great because at certain junctures in the U.S. economy, there's probably no more important ratio for investors and just people that are employees and working in this economy and trying to work through this this time we're in. So at certain junctures, the Dow ratio is the Dow-Gold Ratio is without doubt one of the most important financial metrics in U.S. history. And anyone managing money, whether it's their own or managing other people's money, should be paying attention to this ratio starting today.
And so what exactly is it? For someone who isn't familiar with it, can you just break it down for what we're looking at when it comes to the Dow-Gold?
That's actually a great question, because a lot of people, I think, view the Dow-Gold Ratio in an improper context because they haven't really looked into it as deeply as I have. Let me first say right off the bat, when I first heard the ratio, I thought it was random and arbitrary, but I don't think that anymore. After looking at the history of the Dow-Gold Ratio and the history of the markets, it's one of the most important valuation metrics on how financialized or under-financialized the economy is at any given point. And that's really important because a lot of people think of it as what the real returns are on the Dow compared to non-printable money of gold. That's an interesting metric, but it doesn't really help you position your portfolio. And so when you look at it as a metric, as a valuation metric on when economies get over-financialized or under-financialized, then you can invest and allocate your capital a lot more efficiently, and more importantly, it can really help protect yourself. And I'll explain that as this conversation goes on.
Okay, so what exactly are we looking at right now? Where are we in terms of the exact number for the Dow-Gold Ratio? Where have we been, and what is significance about where we are right now?
Sure. So first, anyone listening to this, I would suggest in just a moment, push pause, since you can do that, and go to macrotrends.net and pull down the Dow-Gold Ratio. It's a fantastic chart. It's a 100-year chart, and you should copy and paste it into Word and print it out. And I highly suggest you do this. Copy and paste it, copy it to Word, and print it out, because you'll see some startling statistics just by doing this and actually doing a hands-on experience. And when you print this chart out, you'll see that as the chart is rising, the Dow is actually rising against the value of gold. And when the chart is going down, gold is actually rising in value against the Dow. And you'll see very, very long cycles, and you'll see some very, very interesting points as we go through this.
Okay, so right now gold is around 1,100. The Dow is over 1,700. I think around 17.5. I haven't even checked in the last couple days, but so we're at around a 16 at this point, right, Nick?
So, we are. So,
and then
right.
Where have we been in terms of, like, you know, what's the significance of 16? What should people take from that number?
Okay, so let's put this in easy context, okay? The higher this ratio goes, the more likely it becomes you'll get into a zone where it's just absolutely a no-brainer on how to position your portfolio. And that's why this is a really important metric today, because we're just about there now, where it becomes an absolute no-brainer on how to prepare and plan for your portfolio. And let me give you an example. So the Dow's been rising against gold, and we're at about a 16.5 Dow Jones to gold ratio. At the 1929 peak, the Dow Jones gold ratio hit 18. That was just before the Great Depression started, and it took 25 years for people to make their money back in stocks. In 1966, the Dow Jones gold ratio hit a peak of 28. And it took 16 years for people just to have a flat return. And in the interim, they had a couple 50% drops on their Dow Jones stocks. That was when it hit 25. In the year 2000, during the insane dot-com bubble, the Dow Jones ratio to gold hit about 40, 45. Those were the extreme peaks in the Dow gold ratio over the last 100 years. And so we're at 16.5 now. We're just a hop, skip, and a jump away from 18, which was the start of the Depression. Now, this is what's interesting. Even now, at this ratio, but especially when you hit 18, this is a very, very important note. There's virtually no way, there's just the law of physics, the law of nature, there's virtually no way once you hit, even now, but especially above 18, there's no way that at any time in history has the Dow ever outperformed gold sustainably from these valuation metrics. But it's not just about gold, it's about protecting your portfolio and how to position. So it's about total portfolio allocation. This isn't a gold call or a Dow call. This is a portfolio allocation call on how to protect your portfolio as this ratio skyrockets to unsustainable levels. And we're just about there. I mean, it's right there.
Yeah, no, it is really interesting, especially when you bring up those correlations. And I think I was talking to you, and you were saying 13 was a significant number. When the Dow-Gold ratio gets to about 13, that's a number to look at to start repositioning your portfolio, especially if you look at that chart, which, by the way, we'll have on the interview when you're watching it. We'll have a picture of this chart so people will be able to watch it while you're watching it on YouTube. But
that would be fantastic. Yeah, anytime the Dow's actually gone above a ratio of 13, it's proven that it's not sustainable, and eventually the Dow will come below that. The beautiful thing for investors today is actually at 16.5, and if we can get over 18, it becomes potentially one of the greatest setup in our lives, where these kind of opportunities only come around every so often. And so, but back to the financialization metric and those key points I'm talking about with 1929, 1966, and then 2000, let me demonstrate how this is a financialization valuation metric to use. So when you think about financialization, what it really comes down to is a very simple sort of soundbite: easy money and loose credit. So when you think about that, easy money and loose credit, those are what create financialization, unsustainable financialization bubbles. And so let's look at 1929 in the Roaring Twenties. The Fed actually was doing exactly what our Fed's been doing recently, which is printing money. It was held captive in the banks. The banks got the green light from the Fed to loan it on margin for stock investing, and that created the Roaring Twenties and the stock bubble up to 1929. So it was really the financialization of the Fed that engineered the Roaring Twenties and the 1929 stock bubble and the subsequent peak. If you look at the 1966 peak, when the Dow gold ratio hit 25, the Fed was essentially monetizing the government debt because they were spending money bringing in because of the Vietnam War and then Johnson. So the Fed was actually that creating a financial assets again essentially because the gold was pegged to the dollar at $35 an ounce, and there was nowhere for money to go. So money went into the Dow Jones and the Nifty 50, and you couldn't go wrong. But of course, anytime something gets unsustainable, your future returns are only a function of the price you're paying today. So that was the financialization of the 60s that caused a high Dow-Gold ratio. And then if you look at the year 2000, same thing. Greenspan came in and saved long-term capital management with the banking cartel. And as they did that, the Greenspan put essentially became famous at that juncture by lowering interest rates, despite the fact that we're clearly going into one of the biggest stock bubbles ever. He had lowered interest rates and didn't raise them until 2000 something, once the bubble was out of control. And that's the other time that the Dow-Gold ratio hit an extreme high. So look at today, compared to those other three extreme ratios of 1929, 1966, and 2000, which turned out to be a fantastic time to own real assets and lighten up on financial assets. We're at nearly at the same juncture today, and what's going on today in this financialized economy? We've got the same thing. We've got easy money policies and loose credit. And the loose credit is simply the 0% interest rates is causing financialization with companies borrowing, going on debt, and buying their stock back. It's very similar to the housing bubble, where anyone was able to get easy credit while the cost of money was near zero. Greenspan had interest rates at 1%. So this is all the financialization that causes these unsustainable valuation metrics. And the Dow-Gold ratio essentially tells you all this. You don't need to follow every nook and cranny as I do. You just need to look at the Dow-Gold ratio and realize this is a natural pendulum, and it's just gotten more volatile since 1913, since the Fed came about. So never before has financial assets vacillated so far around what the true economy can support. And by following the Dow-Gold ratio, this can help you, allocate your portfolio more optimally. And so I think it's one of the most important tools that investors should be looking at today.
Yeah, so I think it's really interesting how the Dow-Gold ratio really goes to show the fundamentals of the economy. It seems like it could be some detached number, but it really goes to show what's going on with what you're calling the financialization of the companies. Now, I kind of want to talk about, we're at one extreme at the moment where gold is low and stocks are getting up there, getting high, so the ratio is high. But can you give us some examples in history where the Dow-Gold ratio was low and it has proved to be a credible ratio for the reverse of your portfolio allocation?
Hey, Kenny, that is an absolutely fantastic question, and no one's asked me that. And actually, this is where I have some exclusive information and exclusive and powerful research that I have seen no one anywhere produce. And so your question goes to anyone who's a value investor, aka real investor, meaning you're buying an asset that you're buying undervalued and you're holding. So let me get to the mother of all value investors, which would be Warren Buffett, and his mentor, Benjamin Graham. Now let's see how they, and what actions they've taken at certain junctures on the Dow-Gold ratio. So in 1966, Buffett was running a money management firm, and as the market got over financialized, Buffett sent his partners their money back and said, I just can't find value. And so he just sort of went in hibernation mode for a few years. Well, when the Dow-Gold ratio finally started to come down into a more normalized territory, meaning gold was going up in value against financial assets and great companies were coming down in price, well, that's exactly when a guy like Buffett comes in, while everybody's scared and everyone's running to the hills. What Buffett is doing is that's when he becomes a big buyer, and that's when he's made all his big money. So he's almost one of the greatest value timers of all time. And if you follow the Dow ratio, the Dow-Gold ratio, you can use that as your own valuation metric to become an investor and make great calls like Buffett at key turning points. And so what Buffett did was when the Dow-Gold ratio started to bottom in 75, 76, that was the first time he really started to plow money back into the market again, while no one wanted to own stocks at that point. Everyone wanted to own only gold, only silver, only oil, because that's what was working. You know, people have the worst tendency to extrapolate the recent past into forever, and that's why people end up becoming horrible investors with bad results. What you want to do is almost do the exact opposite of the crowd. And so what Buffett did was, as the ratio dropped and financial assets actually became somewhat cheap against gold, that's when Buffett went plowing in and bought massive amounts of stocks and started to accumulate assets under Berkshire Hathaway, which has now become famous. When the Dow-Gold Ratio got high in 2000, what Buffett did was, financial assets were expensive, he just lowered his risk profile. He sat back and he waited. And when the financial crisis came in 2008, 2009, and financial assets finally became cheap again against the Dow-Gold Ratio, so the Dow-Gold Ratio dropped, Buffett went in again and just started pouncing on wonderful opportunities while everyone else was running the opposite direction. So it's a lesson that you should almost always be doing the opposite of what the crowd is doing. Right now what the crowd is doing is this ratio gets to completely unsustainable ratios. Buffett is actually now not buying a whole lot. His cash never before, and this is a future opportunity fund for him. So when the Dow-Gold Ratio gets high, it becomes a fantastic opportunity to buy some of the greatest assets at the greatest prices that will compound for a very long time. And so you can use the Dow-Gold Ratio on both sides. When the Dow-Gold Ratio gets too high, you want to reallocate into assets that are cheap and that will do wonderful over time. And as the Dow-Gold Ratio gets too low, same thing. You want to reallocate towards where the cheap and great assets are. And so it's just a pendulum that swings. And it's not going to change. I mean, it's a natural pendulum. It just got more volatile since the Fed was instituted in 1913. But it's something that correlates exactly to what Buffett was doing. And it's not just Buffett, but his mentor Benjamin Graham in 1929 was invested in the stock market. He was a rookie. He didn't know what he was doing. And Benjamin Graham, who eventually wrote Security Analysis and The Intelligent Investor, which Buffett calls the best book ever written, he devised these because Graham was wiped out in the stock market. He was just speculating. He didn't know what he was doing. When the stock market started to rise again, he borrowed some money and got wiped out twice. So the people that often quote from Warren Buffett to Rick Rule, two opposite ends of the spectrum, but both of them will praise the Intelligent Investor from until high noon. Well, this guy got wiped out twice in the 1929 depression in the stock market. But what Benjamin Graham, being an intelligent guy, he thought there's got to be an answer to this. There's got to be something behind this that I'm not catching. And that's when he realized that when you own a company or any asset, you own ownership of that asset. You're a part owner, and that your ownership better have some kind of valuation, or your ownership better be at a price that can equate to good future returns, which means you better be buying cheap. And so Buffett learned from Graham, and obviously Buffett did a great job, because right now Benjamin Graham would be rolling in his grave, but he also, was rolling in his grave in 1970. And he definitely would have been rolling in the grave in 2000 with common stocks, because, he learned his lesson and Buffett learned from him. That's why Buffett's never been wiped out. That's why, he's constantly capitalizing on crises. And the crises create opportunities in both directions for a Buffett or a Rick Roll. So it's definitely something that people should be using to their advantage.
Yeah, no, that's really interesting, and I like having these type of metrics to be able to value something. And I think a lot of people, they assume that this is just going to mean get out of the stock market, go into gold, or go from gold into the stock market, and that's not what you're saying. You're just saying this is something to look at to be able to reposition your portfolio. And just like even Buffett's doing, he doesn't even own gold. He's going from the stock market to cash, and then back to the stock market and doing different investments within that. So I think it's a really interesting thing. So Nick, I wanted to just give you an opportunity. Do you have anything else that you wanted to add for this interview? And also, where can people find out more information about you and learn about what you do?
Sure. So one more thing about the Dow-to-Gold Ratio is don't take it for granted. It'll be a huge mistake. And look at the chart and really draw a line across the chart from the point we're at today. And just look at how short a period of time the graph stays above that line. So I hope you did that, and I hope the readers listening printed out this chart and can draw this line, because they're going to just have an aha epiphany moment. It's not unusual that we are where we are. What will be unusual is if it doesn't revert to the mean, and it always has and it always will. But back to me, where people can find me is at FMT Advisory. And I'm a fiduciary advisor, so only 4% of the entire financial advisor community can claim that they're a fiduciary advisor, which means I have your back even when you're not looking, no matter what. And I have to put our investors' interests above our own at all times. And that's simply what it means. So if you go to our website, you can sign up for our research, and you get some of this information and some of our leading ideas in this new economy. So I hope people would like to join me in this new economy revolution that we're leading.
Sounds good, Nick, and we'll have the link at the bottom of this video as well. Nicholas, thanks so much for taking the time to come on the show today. I look forward to future conversations.
Hey, Kenny, thanks so much for having me, and keep doing the great job that you're doing.